Opendoor Technologies is currently trading at $7.78, down a steep 4.36% on the day. And while the screen flashes red, the common chatter you'll hear is that this is just another growth-oriented tech name taking a hit in a volatile market. The expectation has always been that Opendoor, with its algorithms and promise of a seamless home selling process, would eventually dominate the antiquated real estate industry. But that narrative is dangerously incomplete. The reality unfolding right now has very little to do with tech disruption and everything to do with the brutal, unforgiving mechanics of the physical housing market. What we are seeing isn't a temporary dip in a tech stock, it's a direct reflection of a company whose entire business model is chained to the anchor of rising interest rates and falling home prices. The algorithm can't save you when the fundamental economics of your industry turn toxic. The story of today's trading session for Opendoor is a textbook example of this conflict. The stock opened the day at $8.22, showing a brief flicker of optimism, perhaps from traders looking for a bottom. That hope was quickly extinguished. The price cascaded downwards, breaking through several psychological support levels to hit a low of $7.45. This wasn't a slow bleed, it was a rapid descent, indicating a clear lack of buying pressure and a surplus of sellers rushing for the exits. The subsequent bounce back to the current $7.78 level is weak, suggesting it's more likely short covering than genuine conviction from buyers. This kind of intraday volatility, a swing of nearly 10% from the high to the low, tells you that the market has no firm grasp on Opendoor's valuation. It's a battleground stock, and right now, the bears are winning decisively. This isn't the kind of market action you see with a stable giant like Apple stock. This is the raw, high-stakes game of a company whose fate is tied directly to macroeconomic forces it cannot control. Many retail investors watching this on their Robinhood app or through their SoFi Invest account are likely feeling the sting of this downturn, a stark reminder that not all tech is equal. The trading volume accompanying this price drop is also telling. While not astronomically high, it's been consistently elevated during the sell-off, which points towards institutional distribution. Large funds, the kind that use sophisticated platforms like interactive brokers for their execution, are not accumulating shares at these levels. They appear to be reducing their exposure. This is critical because the initial bull case for Opendoor relied heavily on the idea that big investment would back its vision. Now it seems that institutional patience is wearing thin. They see the same thing we do. A company that must buy and hold billions of dollars in housing inventory at a time when the value of that inventory is actively declining. Every basis point increase by the Federal Reserve is another turn of the screw for Opendoor, increasing its cost of capital and further dampening housing demand. It's a vicious cycle. The very economic conditions that hurt its ability to sell homes also increase the cost of holding the homes it already owns. This is a far cry from the capital-light software models that investors love in a name like NVIDIA stock, which sells the shovels for the AI gold rush without having to hold the underlying assets. Opendoor is holding the assets, and those assets are depreciating. The expectation was that Opendoor's technology would give it an edge, allowing it to price homes more accurately than the competition and manage its inventory with surgical precision. The reality is that no algorithm can accurately predict the peak of a housing bubble or the depth of the subsequent correction. In the second and third quarters of last year, the company was forced to write down the value of its inventory by hundreds of millions of dollars, a direct consequence of buying homes near the market top. These aren't just paper losses, they represent real capital destroyed. For anyone managing their portfolio, whether through a self-directed Fidelity brokerage account or an automated service like Schwab Intelligent Portfolios, this is a massive red flag. It calls into question the core competency of the business. If the main technological advantage doesn't protect you from the biggest and most obvious risk in your industry, how much of an advantage is it really? The company is essentially making a massive, leveraged bet on the direction of the housing market, and for the past year, that bet has been catastrophically wrong. Let's be clear about what Opendoor actually does. The business model is known as iBuying. They make near-instant cash offers on homes, aiming to provide sellers with speed and certainty, bypassing the traditional, often lengthy process of listing a home. After purchasing the home, Opendoor performs light renovations and then lists it for sale on the open market. They make their returns from two primary sources: a service fee charged to the seller, typically around 5%, and any appreciation they can capture between their purchase price and the final sale price. During the housing boom of 2020 and 2021, fueled by historically low mortgage rates, this model looked brilliant. Home prices were only going up, so the risk of holding inventory was minimal. The company could buy a house and be reasonably confident it would be worth more a few months later. But that environment has completely inverted. With mortgage rates now hovering at multi-decade highs, housing affordability has plummeted, and demand has fallen off a cliff. Now, the homes Opendoor buys are more likely to be worth less in a few months, not more. Their primary source of profit has become their primary source of risk. Comment below what you believe the national average 30-year fixed mortgage rate will be by the end of 2026. Do you see it falling back to the 5% range, or are we stuck in this higher rate environment? Looking ahead, the path for Opendoor is fraught with peril, but not entirely without bright spots. The bearish case is straightforward and powerful. Continued high interest rates will keep the housing market in a deep freeze. Transaction volumes will remain low, and home prices could see further declines, leading to more inventory write-downs for Opendoor. In this scenario, the company would face a severe liquidity crunch, as its capital gets tied up in homes it can't sell at a profit. Competition from traditional real estate agents, as well as other iBuyers, remains fierce. The company's survival would depend on its ability to manage its cash burn and correctly call the bottom of the housing market, which is notoriously difficult to do. Many investors looking for steady, long-term growth through Fidelity ETFs or other diversified investment vehicles would likely steer clear of this level of uncertainty. But there is a contrarian bullish argument to be made. The expectation is continued pain, but the reality could be that the worst is already priced in. If the Federal Reserve signals a pivot and begins to cut interest rates sooner than expected, the housing market could thaw rapidly. A flood of pent-up demand could be released, and Opendoor, having survived the downturn, would be perfectly positioned to benefit. With a leaner cost structure forced upon it by the downturn and more disciplined inventory management, a rebound in the housing market could lead to a dramatic recovery in its stock price. The company is also expanding into adjacent services like mortgage, title, and escrow, which could create a more diversified and resilient business model over the long term. If they can successfully bundle these services, they could create a one-stop shop for real estate transactions that is truly compelling. This is the high-risk, high-reward proposition that might attract a certain type of trader using platforms that cater to active investing, like the SoFi trading platform or Robinhood. It's a bet that the company can outlast the storm and emerge stronger on the other side. You don't find this kind of asymmetric risk-reward profile in something like Tesla stock at this stage. Opendoor is much more a binary outcome. In the end, the story of Opendoor stock is a powerful lesson in the clash between a compelling narrative and a difficult operating environment. The expectation was that of tech disruptor, an algorithm-powered machine set to conquer a legacy industry. The reality is a company that is fundamentally a real estate speculator, deeply exposed to the cyclical whims of the housing market and monetary policy. The recent price action, the institutional selling, and the fundamental business challenges all underscore this reality. For the stock to work from here, it's not about a better algorithm or a slicker user interface on an app. It's about the Federal Reserve, mortgage rates, and the basic supply and demand for physical houses across America. The tech is merely a wrapper for a deeply cyclical, capital-intensive business. Understanding this distinction is the key to making a sound decision, whether you are a long-term holder using a Fidelity wealth management service or a short-term trader trying to catch a bounce. The promise of disruption is alluring, but the reality of the balance sheet is what ultimately dictates the outcome.